We just closed another quarter in the economy, and wow, has it been a wild ride. Inflation is still high, we had banks that were failing, and yet the market seemed to simply just brush that right off. We're getting to this point in the economy now where we're just gonna be gliding into the next season, and you have to understand what's going on in order to plan for the rest of the year, especially if you're retiring. So we've done the work for you, and we're gonna talk about the most important details you should know. And you don't wanna miss the end where you can take a screenshot of the summarized page. So like I said, our economy is entering a period where it's just gonna be gliding, and here's what I mean by that. Assume for a moment that we are right here, and this line represents time. So moving forward in time. Well, up until now, the Fed has been increasing interest rates, right? Once they reach what's called their terminal point, which is the highest point in which they want to hold interest rates, they're gonna stop that increase, and we're getting to that point really soon. So what happens after they stop? Well, we sit and we watch. At some point in the future, they're gonna get to a place where they need to start reducing rates again, because holding interest rates at these levels is really not good for the economy in the long term. And so between now and then, we're kind of in this free float situation where we have to see what the impact of higher interest rates does to the economy. It's kind of a weird place because all of a sudden it's gotten much more expensive to do business, and so corporations will start to see an impact soon. And so some big questions are, if you're gonna be retiring soon, how does this impact your plan for the next 12, 24, 36 months? There are more risks present to retirees now than there were before. And in the meantime, the markets have essentially ignored all of the economic data and continued to still rise. And so let me explain why this has been the case. You might remember I've said before that the markets always trade in anticipation or ahead of economic data. And at this point, they're actually pricing that the Federal Reserve is going to cut rates before the end of the year. Now, this is an extremely aggressive assumption by the markets, given the real data that's coming out of the economy right now. And frankly, the markets don't always behave rationally. For instance, think back to 1987 when stocks fell 25%. Did the world economy fall by a quarter? No, it didn't, just the markets. And so the point is, sometimes markets behave in ways that are not really rational or supported by the data. And this is something that we need to understand as investors. Let's look at Q1 of this year. Many of the areas that were strongest this year were actually ones that were weakest last year. This is one of the reasons we focus on being well diversified within the various indexes of the markets. The markets are cyclical in nature, and so this type of behavior is something that is constant throughout time. The one thing that's different now is how quickly the cycles are changing. For a long time, growth stocks, like most of the top 10 stocks in the S&P 500 or the C Fund, did well for about a decade, while many others were lagging. This was a much longer period than is normal, and last year the environment completely changed. Now, something that's gone mostly unnoticed is how well developed international stocks have been doing lately. Generally speaking, we're usually very US focused because domestic stocks tend to lead the way, but international has been ahead of the curve for quite some time now. And so this really helps portfolios that are set up correctly. And so again, while we focus on US, it's important to be geographically diversified as well. You'll notice not only did they do much better than everyone else last year, but they're still rocking and rolling through this year as well. And some others like commodities, for instance, well, they've been getting crushed pretty much the whole time. Something else to note is that historically, value stocks tend to do better than growth stocks during periods of higher interest rates and higher inflation, which is where we're in right now. And when we look at this line, when this line goes up, value stocks are doing better than growth. When it goes down, growth stocks are doing better than value. And we're starting to be in this section here where it's starting to go back up again, and we're seeing the trend of value stocks really take traction compared to growth stocks again. And so if we continue to see rates remain high, it could be a signal that value stocks still have an advantage. And if we expand valuations, which is how we value the price of a company, even beyond just domestic and look internationally, we can see that the spread is even bigger. When we look here, we can see that US stocks are trading at a much higher premium than some international stocks relative to its value. And so if we look here, this is why that many economists are still very skeptical about US stocks in particular, but equities across the board. There's just a much higher premium on US-based stocks compared to other internationals, and we've seen that be the case as international has really taken up traction lately. And when we look at the fixed income markets or the bond markets, we can really see how dramatic the shift in interest rates has been. On the right side here, this blue line was last year and represents treasury yields. And so if we look here, the 1-year treasury bond, for instance, was at around 1.5%, where the 30 was at about 2.5% last year. And if you notice the general shape of this curve here, this is a normal shaped curve. Now, this dark blue line here at the top, that's representing this year. And you can immediately see how the shape of this curve is inverted. And this means that short-term bonds are all yielding much higher than long-term bonds. And when this happens, this is typically a sign of economic stress. This means that people don't want to lend their money out for a really long time. They want to hold on to their money. They're willing to lend it for shorter periods of time compared to longer, which is why shorter bonds are paying more than longer bonds right now. Historically, this is one of the signs that economists use to try and predict a recession. An inversion of the yield curve has preceded most recessions in the US economy. But at the same time, this is why bonds look so attractive right now. There's a lot of opportunity inside the bond space right now, and so many portfolios are moving towards strategies like bond ladders and other various things. So why is it that the markets keep going up? I want to point out that right now the markets have been pricing in an interest rate cut by the end of the year. Remember, markets tend to price in anticipation of what they think is coming. However, the markets are not always correct. Given how stubborn inflation has been, it would be really surprising to see the Fed chairman start to reduce rates before the year ends. If you ever took a class in economics, you'll remember that the Fed's target rate for inflation is just 2%. So the likelihood of inflation having been brought down to those levels again is fairly low unless we see a deep recession during the summer. If you think back to the 80s, one of the reasons that inflation was so high was because the Fed did not pressure down inflation hard and fast enough. And so the current Fed is very sensitive to that, and they want to make sure that they don't repeat that. Now, I'm really curious about what your thoughts are. How do you think the first quarter went? How do you think the rest of the year is going to go? There's no argument that there's a lot of mixed feelings still. And so will you share some of your thoughts in the comments below? I think that would be nice so that we could share our thoughts and help one another make better decisions for the year. Okay, so as with most quarters, there's both good news and bad news, so let's cover this next. So to start, economic growth was still pretty strong and markets were going well. Now, the challenge is that it means inflation is still a little bit higher and rates are going to probably continue to have to remain high to curb that inflation. As a result to the bank scare that we had, the good news is that thank God it wasn't another repeat of 2008, even though it did cause some regional banks to really take a hit. And what we're gonna see is a tightening of lending going forward, and money is more expensive now because rates are higher, so ultimately that will impact consumers and probably help slow the economy a little bit. The other good news is that we're getting to a point where the Fed is going to stop hiking interest rates. So they're reaching their terminal rate very soon where they're gonna hold it at that level for some time, which in theory should really help reduce the inflation we're seeing. The bad news is the markets seem to not get the message and are actually pricing in cuts by the end of the year. So if they're wrong, this probably means that we're gonna see more volatility before the year ends. With that, stocks have been resilient, and despite rising interest rates, corporations still seem to be doing okay. Labor is still very strong. We still have very low unemployment throughout the country. Now, the bad news is that a lot of these gains that we've seen have been very concentrated. Very few companies, with much of the market still very, very restricted and very much down from last year. And so as you think about your plans going forward, make sure you take these elements into consideration. If you're retiring, setting up your income plan for the first several years is very critical, because if volatility comes at the same time that you're going to be retiring, that could prove to be challenging if things aren't set up correctly, and often could mean that you're not able to continually stay retired. So make sure you do the research, do the planning, and invest the time. And until next time, stay wise and stay wealthy.